Hi, I'm Jimmy. In this video, we're looking at Amgen Stock, ticker symbol AMGN. This video is part of our Dow 30 series, where we're analyzing all 30 companies in the Dow Jones Industrial Average to see which ones could be a good buy today, which ones are reasonably priced, since we know a lot of the stock market is overvalued right now. I'll leave a link in the description below to all the companies we've done so far. Okay, so we're going to look at the very basics of Amgen's business, and then we're going to see if we can come up with a fair value for Amgen stock using discounted cash flow, kinda. I'm actually doing it in a very unique way, so stick around for that. Okay, so let's jump right in. So Amgen is a biopharmaceutical company, and what they do is they research and create medicines. And we could break out their different products by revenue. This is according to revenue in 2020, and we can see that broadly speaking, they make a decent amount of products. And yes, last year about half of their revenue was generated by just a few products. And this is actually one of the keys for a company like Amgen to be successful, and that is that they need to continuously develop or acquire new products because it takes a ton of time to ultimately get approved to launch a product, and many of them are not that successful. So when they have one, they got to take it and run with it. Just to illustrate, this article came out just a few days ago talking about how Amgen's newest cancer drug, Lumicros, I'm not sure how to pronounce that, but it was approved for some patients, lung cancer patients, to take if they have a genetic mutation, and they've already tried other therapies that didn't work. And this is actually one of Amgen's specialties. They often try to treat complications that come from different illnesses, and the most recent drug approval is a good sign for Amgen, since it's estimated that this drug could generate more than $1 billion on an annual basis just from this drug alone. Okay, now with that being said, let's shift over to Amgen's revenue. So when we look at Amgen's revenue, well, we can see that overall the trend is in fact moving higher, which is a good thing, but there are some ebbs and flows from year to year, and a lot of that revolves around which products are running and whether or not they get a new product. One good example of this, when we go back to the pie chart here, well, this Otezla product here, Otezla was acquired by Amgen from Celgene back in 2019, and it cost Amgen about $13 billion to make that acquisition. Now, clearly, if you're going to spend $13 billion on an acquisition like this, well, you're going to have some confidence about a few different factors. They've got to consider things like the political climate, when the patents might expire, not just in the United States, but around the world. Plus, they have to determine how many people are suffering with the ailments that this drug could help, and what can they sell it for, where are the new competitors coming from, when might there be a new competitor that gets approved, and after taking in as much information as they can about that particular product, they make projections. And then they have to discount those projections back to today, and ideally they end up paying less than what they project they will be able to do with it. Now, with that in mind, what if we were to look at projections for each of their individual product lines and discount all of those projections back to today? Well, in theory, this would be a good way to come up with the fair value for the entire company. If you could come up with a fair value for what all their products are, you could come up with a fair value for the entire company. And that's exactly what I did here. This is my discounted free cash flow analysis for Amgen stock. And if we're not too familiar with this type of chart, well, this is called a waterfall chart. And basically what it does is it looks at how each different component of the business adds to the overall value of the entire company. So what I did is I took analyst projections for each of their drugs. I looked for projections going out to 2030. And then all we have to do is we take those projections, discount that free cash flow back to today, and sum up what each individual product line is worth. Now, I used my typical required rate of return of 7.5%, although when I was looking at different analyst reports, I kept noticing that they were using less than that. A lot of them were using 7, sometimes even less than 7%. But I stuck with 7.5% to keep all of our analysis comparable. And I should also point out that I typically use a perpetual growth rate of 2.5%. A perpetual growth rate is how long you think a company, or a product line in this case, would grow forever. I typically use 2.5% because that's about the growth rate of GDP, and that seems like a safe number to use. In the case of Amgen, I actually used a negative growth rate. I used a negative 1% perpetual growth rate because at some point, all of these products are going to die off. and they're going to have to be replaced with new products. So I use -1% just so everybody understands what I did. And just to illustrate the process real quick, here's one example from one product just to show you how I did the whole thing. So what we did is we took analyst estimates going out to 2030, and then we had to come up with a terminal value. That's where the growth rate and the perpetual growth rate come into play. We discount all those back to today, and then we ultimately divided that entire value by the shares outstanding, and that gives us how much this particular product contributed to the value of the stock today. Now, there are some important points to notice in this particular calculation. First, we might notice that from 2024 to 2027, we see a gradual decline in the expected revenue and free cash flow from this particular product. And a lot of that is due to the fact that some competitors are expected to come online, so there is expected to be some decrease in the volume that they're able to sell. But then in 2028, we might notice that we see a huge jump off a cliff. And that's because Amgen has patent exclusivity going through 2028. Plus, their European patent expires in 2028 as well. So come 2028, both the US and Europe will be exposed. Now, I did read that many of their patents expire in 2024, and many of their US patents. But I believe that there are 11 patents protecting this product, and ultimately, they have until 2028 where they are exclusively allowed to sell this drug. But still, that's why the Otezla value falls off very quickly towards the tail end there. So one of the tricky parts about doing this type of calculation is you really have to look into each individual product. So the base business here, well, this is just a grouping of most of the products that we looked at before on the pie chart. I grouped a lot of them together, especially the older products. I tried to break out some of the bigger products. And we can see those products are estimated to be worth about $142 per share right now. So if that was the only part of their business, if they sold off all the other parts, we have an idea of about where Amgen should be trading today. And then we already saw the Otezla calculation. That one added about $16 per share to the fair value of Amgen stock right now. Then we have Enbrel. Enbrel's their biggest product right now. That one's estimated to add about $40 per share to their fair value today. And then the next one is something known as biosimilars. And biosimilars, they're not exactly the same as like a generic drug. A generic drug, if a company creates a product, they create a drug, a generic drug copies the exact formula of the original one. Biosimilar, what they do is they take the original formula and they sort of tweak it to create a new version of the drug. They're much easier to get through the FDA. They're much easier to get approved because you can use the original research from the first company with just some tweaks to it. So it's similar, but not exactly the same as a generic drug. Well, projections for Amgen's biosimilars are expected to add about $46 per share. Then the pipeline is expected to add about $61 per share. Now that's because we're projecting out to 2030. If a drug comes online next year, well, we want to project that out now. We don't want to just ignore and stick with current products. We want products that could also come live between now and then. A good example of that is that cancer drug that we looked at a few minutes ago that's approved for some patients in some situations to try. Well, that drug is something that is in projections. That $1 billion plus a year that they're projecting, that is built into these projections. That is where that value comes from. Then we have $34 per share in other revenue. And this could be a few different things. For example, in January of 2020, well, Amgen bought about a 20% stake in a company to help their oncology presence in the Chinese market. And that's just one example of the type of revenue that could appear there. It's not directly related to a product, but it is something that they're going to generate some revenue for. Okay, then we have the red bars. The red bars are clearly taking away from value. I assume it's obvious that we can't just take the value of the drugs and say, okay, that's the value of the whole company. That might work if we were considering buying the company, then maybe selling off all the pieces. Perhaps that can make sense. But since that's not what we're doing, well, we do, in fact, they're going to have some corporate expenses that we have to account for. So in this case, we give back about $76 per share to account for the corporate expenses. Then we have their net debt. So net debt, we take long and short-term debt, and then we subtract any cash that they have. What is remaining in this case on a per share basis is about $39 per share. So again, that takes away from their overall value, leaving a current value for Amgen stock of about $225 per share. Right now, Amgen's trading around $240 per share. So again, like a lot of the stock market, this one appears to be at least slightly overvalued right now. Now, one good part about valuing the stock using this type of method is that let's imagine that something happened and let's say a new drug just came out from a competitor and that drug is going to compete against one of their products. Well, by doing it this way, if we knew how much each drug was contributing to the overall value and we heard the news, oh my God, this stock is going to get hurt because a new competitor just came out, and we've already calculated the value of that one drug, oftentimes the stock market overreacts to that type of news. They turn around, they sell off that stock way more than it should be, but a lot of them bounce once everybody figures out what's going on. Our job here is to try to figure out ahead of time. So if we were to keep up with this type of calculation, update the numbers as new information came out, well, this could be a very valuable way of looking at a stock like this. Now, if we're trying to come up with a fair value for a stock, and this one's, let's say, a bit too complicated or a bit too time-consuming for us to do, because I'll admit, this can take a decent amount of time to put together. I just thought it would be interesting, that's why I did it here. But if we're looking for a simpler method, well, I actually did a video where I looked at some of the best ways to value stocks in general. So if you're curious, perhaps that's a good next video for you to watch. I got a link right here, I got a link in the description below, and thank you so much for sticking with me all the way to the end of the video. I really appreciate it. Thank you, and I'll see you in the next video.